Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And look who's with me today. It's the professor himself. If he wasn't in commercial real estate financing, he'd be teaching history at the University of Texas, his alma mater, Mr. James Eng. James, how are you?
I don't know about history, maybe economics, macro, micro, but history, I'm not there yet. Maybe in a couple more years.
That's okay. Everybody knows you're the professor and you're smart as a whip. Typically, we would have Mr. Michael Becker, the governor of the great state of Texas, but he is on another due diligence assignment. So he wishes he could be here, but we're in good hands with James. So, James, tell us a little bit before we get going, some of the things that are coming up in the Old Capital world. Can you just give us a little brief?
Yeah, we got 3 events coming up in February, March, and April. So February, just get your calendar out here. February 13th, which is Monday, we're going to have Greg Willett come in and speak to us about really the 4 major metros and what he's seeing across A, B, and C class. And then March 22nd is JP Conklin with Pinsford. And he's going to be talking more about sort of the second Fed meeting. So we got a Fed meeting on February 1st, but then we also have one March 22nd. And then on April 6th, we have our strikeout homelessness, which, we had a couple injuries, a couple people on the injury reserve list from basketball. So we're taking a break from basketball and moving over to the lanes. And hopefully we don't have any injuries this year.
Hopefully I don't get hurt like I did last year with a broken wrist playing basketball at my age, so to speak. So craziness. But talking about these 2 guys, Greg Willett, one of the smartest guys that I know about in the multifamily space. He works for IPA. He was with RealPage for about 10 or 15 years. Just an unbelievable economist. Kind of tell us a little bit about what's going on in multifamily in terms of rents and growth of NOI. He's a sharp guy. You want to come see him. Then second is JP Conklin, as James mentioned. JP flies all the way from North Carolina to see us. With Pinsford, he is the interest rate guy, and so he's going to tell us where interest rates are going. And so we look forward to seeing you. How do people come to the Old Capital event, James?
So go to oldcapitalpodcast.com, and then on the right-hand side, there'll be a link to register for those 2 events, and we will see you here in Dallas.
Great. So today we have 2 of our friends that we've known for a long period of time, and I want to introduce you to these two gentlemen. They found a company called GREA. And GREA is a real estate brokerage company, and companies are the people that we want you to meet behind GREA. So in the podcast today, we have Mark Allen. Mark, how are you?
All doing well. Thanks for having us.
No problem. And then also Todd Franks. And Todd, thanks for being on with us too.
Hey, thanks for having me.
So I'm going to kick it over to the Grand Inquisitor, Mr. James Eng. And let's kind of keep it positive today, James. Let's keep it positive. I want to hear a lot of good things of why people are in multifamily. And let's talk a little bit more about GREA.
All right. Yeah. So I think to kick it off, you guys have been in the business a long time. Maybe we'll start with Todd and then go over to Mark and give us a little bit of sort of your background in the multifamily space. And then we'll run it up to sort of January 2022 into your transition into GREA. So Todd, maybe kick us off here.
Yeah, thanks. I've been doing brokerage since 2000 and multifamily, B and C class, just workforce housing, Dallas, Fort Worth, generally pretty much North Texas, do secondary, tertiary markets. So I've been through a couple of cycles, and we founded GREA at the beginning of 2022. Mark Allen and I had partnered in 2020, and we were formerly with Greystone Investment Sales Group, and we had a great relationship with them, still do, but just wanted to go out and do our own thing. We, thought there'd be some advantages to doing it. We have found that has been the case. In the last 2 years, the national platform, which has 12 offices across the U.S. In the Southwest, we've got Dallas, Austin, Houston, Arkansas. Midwest, Detroit, Chicago, Southeast, Atlanta, like Hilton Head in Miami, and, presence also on the West Coast there with Portland. And we do have Mid-Atlantic, Philadelphia, and New York offices as well that do quite a bit of business. So that's our offices around the nation. In Dallas here, we have 13 brokers that service our clients. We do about $1 billion a year in transaction volume. Last year we did 88 transactions, I believe it was. So again, just B and C class is mainly what we do. We also do multifamily land. We sell quite a bit of that too. It's a little background on the company. And Mark, I'll let you kind of introduce yourself.
Yeah, I want to hear a little bit of a backstory on Mark, because before you start talking about brokerage, tell us a little bit about how you served our country.
Yeah, so I grew up in Orlando and ultimately ended up at West Point, the United States Military Academy. Graduated there in 2011. And if you go to a military academy, you have to serve back your enrollment there in the U.S. forces. So I was in the U.S. Army as a 13 Alpha, which is a field artillery officer, mostly at Fort Hood, Texas. Loved Texas so much, I decided to stay.
Do you still have your hearing, Mark?
I still have my hearing, although, it's selective hearing.
Yeah, that's what your wife says, huh?
Yeah, 6.5 cap. What's that, huh? You said 6.5 cap? So anyways, been here in Texas for about 10 years, was last at Fort Hood. And I'd like to say I did my research and I said, hey, Dallas, Fort Worth is the best multifamily market in the country, and that's where I'm going. But it was ultimately by God's grace. I got a software sales job, worked there for a year, and I said, hey, this isn't what I want to do over the long term. I was already in real estate investing, doing home flips, and started a network into a lot of the syndicator groups in 2015 and 16. And fortunately met Todd Franks. And then Todd Franks and I got together, joined his team, and the rest is history.
And how many guys do you have on the team?
I think we have 20 in total, including support staff right now. But like Todd said, we have 13 brokers. And we're bifurcated into teams. We've got our secondary markets team, what we call our small balance team, which internally is $7.5 million and under. Then we have a workforce housing team, which is $7.5 to $30 million. And then what we call the institutional team, which is north of 30.
All right. So let's just jump straight in here and maybe take us through, let's go back maybe 6 months and sort of summer of 2022. What was sort of deal flow like, and what were you guys seeing on your deals that were happening?
Yeah, the first half of the year was, when we look at the first 2 quarters, it was a record for us. I think we were closing about plus or minus about 13 deals a month. And I think that ultimately ended up slowing down to about 7 or 8. But, as the Fed started to hike, we started to feel a little bit of turbulence in the capital markets. And, with that, I think I may have had one of the first retrades. And the seller was surveying other brokers and lenders and attorneys. And, he just didn't seem to think, anything was falling apart here in Dallas, Fort Worth. But the buyer being out of New Jersey, kind of being connected with a lot of folks in the Northeast who are buying across the East Coast, where it seemed like everything else was falling apart. He was like, what are you talking about? The whole world's falling apart. And, what do you mean he's not going to accept any kind of credit? Like, the entire world's falling apart. So long story short, it was a 2-property portfolio. And I think that ended up happening like the very early April. And one of those properties ended up falling out of contract. That buyer ended up walking away from his earnest money, but got the other property closed in Grand Prairie.
So any interesting, I remember touring a property in Q3 of last year, and I had never seen this poor broker more beat up in my life on a tour, because it felt like you had to set the deal up not only once, but twice, maybe 3 times, in terms of getting it under contract and then negotiating different retrades. So coming usually in a buyer questionnaire, people ask, have you ever retraded a deal? And almost every answer on every buyer questionnaire is, of course not. I've never retraded a deal. Talk about like buyers and sellers who did it, let's say, well, or who negotiated well, and people felt like it was a win-win. Do you guys have any stories from the last, let's say, 6 months where, people came out on both sides? Like, tell us the characteristics of people that you still want to work with after the last 6 months, because it's been turbulent. There's been no doubt.
Yeah, sure. I'll take part of that one. I had a larger portfolio of 20 properties in East Dallas, and it was a 90-day escrow. It ended up closing about September 30th, end of September. So, the world was kind of falling apart around us while we were in escrow the entire time. And the buyer held steady throughout, the entire process. There was a small ask for some deferred maintenance that wasn't material. I mean, didn't really amount to, probably even 0.1 or 2% of the purchase price. So, that wasn't a problem. But as we got closer to the finish line, lender proceeds got severely cut. And, instead of the buyer coming to the seller and saying, hey, this is the situation, my proceeds just got cut by, it was 12.5 to 15%, somewhere in that range. I can't remember exactly. I need you to step up. They bridged the gap. They asked the seller to come off a little bit, and they picked up, out of that, maybe 25% of what the lender proceeds were cut, and the buyer picked up, came in with additional equity and, filled in the gap. And we got the deal across the finish line to go under contract, or really under letter of intent. It was in, May, June timeframe. And by the time, the end of September hit, it was a much different market, but there really was no material change in price on that large portfolio.
All right. Bring us up to date. What are you guys seeing today on the market? What's sort of like your day-to-day? Like I remember January of 22, there's probably 50 deals on the market in DFW. Talk to us about what you're hearing from sellers, and then maybe what you're hearing from buyers, or let's say current owners, potential sellers.
Yeah, well, there's been, throughout even last year, there's been a pivot as far as debt goes. And it seems like there was a certain point in the summer, early summer, where, and I guess I should preface this, we're in the middle market space primarily. And I would say 80% of our deals are in that 30 million and under space. So we're dealing with private capital. But that being said, in the private capital space, we saw a lot more bank loans at the beginning of the summer. And it was like interest rates were stacked on top of each other as far as agency rates and bank rates. But you could get more leverage with bank, and then, obviously some more flexibility. And then all of a sudden that pivoted as the 10-year treasury yield, the Fed continued to hike, but the 10-year treasury yield ended up dwindling down, in August to about 2.75%. And it seemed like everything was pivoting back to agency. And there was a sense of stability there at that point. And it seems like that bid-ask spread started to close and sellers and buyers met, and then again widened as bank became less prevalent, as the Fed continued to hike, and then 10-year treasury yield jumped back up. So right now, just over the past few months, I mean, for those tracking the treasury yields, it seems like everything has been falling. I think the 10-year treasury yield as of yesterday was 3.37, going from 4.2% to 3.37, that's helping close the gap. So, I mean, we're doing deals, but there's less off market. I think sellers are hesitant to go to market and potentially miss, and then, end up having something that's stale and left out there and having to pull back. So there's a lot of off market activity right now. So, as a buyer, it's a good time. And I feel like this was the case last year too. It's a good practice to reach out to brokers on a regular basis and, just touch base, see what they're working on, what they have in their pipeline. If there's anything, we're submitting an offer on, whether it be, preemptive, going to market or off market. Because again, I think, in today's market, the bird in the hand is still more valuable than it's been in quite some time.
Let's say you guys are doing BOV, and instead of typically they would send in T12 and rent roll and ask for BOV. If you were to peg, let's say DFW, A, B, and C, what caps would you put on in-place income pro forma expenses right now?
I mean, generally, I'd say now A is probably, I'm really surprised at some of the pricing that's coming in on like new construction deals and lease up, even if they're post 60% and may qualify for that pre-stabilization Freddie program. But, generally I'd say somewhere around a 5 cap for class A, B, somewhere in the 5 cap range as well. And that's without tax adjustments, by the way. I mean, it may, tax adjust into the 4s. And C, C was, at one point when, again, the 10-year treasury yield was up in north of 4 and you had, all in rates north of 6%. You had to have north of a 6% cap rate on a 60s, 70s deal, especially if there was a chiller boiler, to get any kind of decent leverage. So, generally I feel like, it's much more a rule of thumb because each and every deal is different. But, for the C deals, I just say, hey, 65% LTV with agency plus or minus. And when I'm talking C, like I'm talking 60s, early 70s and a, workforce location, I feel like I can get that deal done. Now, if it's an 80s deal that's, north of 150 units, we're seeing a lot of those kind of in the 50 to 60% LTV range and potentially even to cost sub 50%. So generally, that's kind of what we're seeing.
Why do you think A and B caps are on top of each other, are very close? Any ideas?
It really depends on if it's stable or not. I think there's usually some value add left in B. If there's some sort of value add story there, there's something you can do with the property. These stable A class deals that are just coming out of the ground and lease up, there's not a lot of value add to it. And you have to generally have, positive leverage or see a path to it after lease up. I think they're still a little compressed with A and B, but we've seen largely a decompression of cap rates. And, just to add on to what Mark said there, I'd say, C class value add space, we're underwriting to, depending on the location, 8 to 8.5 cap pro forma cap rates because the debt, the bridge debt is just expensive right now. It's not high leverage. And so I really feel like, everything kind of comes full circle. I guess going through this, last extended bull run, we saw a lot of our clients, and I know y'all, have the same clients as we do, start out in the value add C class space, and then they moved to B and they went to A, and ultimately they're like, man, I can build it cheaper and, have a better cap rate. And so they got into construction, and, I'm seeing, because the cap rates just compressed so much. And, with the decompression of cap rates, I'm really seeing the opportunities in the value add C class space.
So being what you guys do, which is a very privileged position because you really are the image of what's happening in the market today. So whether it's hot or it's cold, you are just the reflection in the mirror of what's going on right now. So you said that you're not really an institutional representative. You do have some transactions that you've represented in the past that have been institutional properties, but you really are like a lot of smaller, say, syndicators and owners that you guys represent. And you just may want to just tell me a little bit more about who's buying properties these days. Is it the syndicators? Is it the guys that just are able to write these big checks by themselves? Tell me a little bit about who's buying or who you're talking to that is buying properties these days in the last, say, 4 or 5 deals.
It's still a mix today. It got to a point where it was like 95% syndicators through the past handful of years. And then it started to pivot a little bit where, some more family offices or more private capital was coming into the market, definitely from each coast. But that being said, I would say it's gone from 95% syndicators down to, closer to maybe 60% syndicators. And we haven't looked at the hard data, but I would say that's probably pretty indicative of the buyer pool right now. And, it just kind of goes back, especially in the private capital. I mean, if you're going to do a 15, 20, $25 million deal, and, you've got an investor who, may be their own capital, it may be 2 or 3 people putting their money together, and they've got it in the bank, that's much more sure deal than someone who's got to go, raise that equity from retail investors. So generally, I feel like the syndicators, that share of their of the buyer pool has really dwindled down.
How are the conversations today with the sellers? I mean, do they want to sell? It's like always an arm wrestle between the sellers. Is it time to go right now? Is it time to keep the property? How are your conversations these days? And are they long conversations with sellers? Are they asking for BOVs? Do they want the full marketing of the deal? Tell me a little bit about what's going on with the conversations that you guys are having numerous times a day.
I mean, I feel there's, if there's a need to sell, there's a need to sell. And that's where you're going to see a seller today is there's some pressure point, whether it be a partnership breakup, some sort of life event, they always say the 5 Ds. But, if there's no pressure there, we're generally seeing them, wanting to hang on right now and feel out what the market does. So, it's varied in that respect, but it's just, if it's a long-term owner, they're at retirement, we're seeing those folks still like, hey, I've still made a ton of money on this, bought it in the early 2000s, maybe even before. It's appreciated. They didn't hit, the very peak and time the market perfectly, but, gosh, it's, the value's still way higher than they imagined it ever would be at this time. So there's some of those folks that are selling more long-term ownership.
So that's the seller. How about the buyer? Are you guys seeing people coming in from California or New York or Florida?
I mean, you are
wanting to make positions.
Yeah, definitely out of state buyers. I mean, Florida, Texas, the Sun Belt, that's been the story for a long time now. Obviously the political positives here are attracting, everyone. We had 470,000 plus people, moved to Texas and from 21 to 22. So that's, the joke was, we're more concerned that, if the state of Texas and the state of Florida can handle the weight from all the extra people, or if they're going to break off and flow it out into the Gulf and the Atlantic, it's a very good place to be, and that's one thing I'm thankful for more than anything, is just being in Texas. So yeah, there's a lot of out of state capital. There are folks that, they have tax incentives they're chasing. End of year 1031s. I'm looking at the deals that we closed at the end of the year when you asked, just kind of going up the list. It was old school money on the last one. A client I know that's been in the market for over 20 years, they're buying, and, going up. Mark's last deal of the year, looks like that was a syndication group. And, just continuing to go up the list, had another property that it was a gentleman retiring, just like I said, it's just like, hey, I'm done, moving to Idaho to be near my kids. And, the neighboring property owner picked that one up. It was a very quick strike on that one. Ended up being, just quick strike, quick close, kind of cash deal. Continuing up the list, 1031 buyer. So they're varied.
So there's a few of us who have been in this business a while. Paul's been in the business for a little bit. I've been in the business for a little bit. And I just wanted you to give us a flashback. Nobody's thinking this recession is going to be as bad as 2008, 2009, 2010, 11. But basically, my role at GE, I was an underwriter. We were originating loans left and right in 2006, 2007, securitizing them to CMBS. And all of a sudden in 2008, you looked around and you weren't originating anything. You were an asset manager now. And you were making sure that all the loans that you did paid back. So take us back. I wasn't in the building at that time. Take us back to sort of 9, 10, 11, and some of the lessons that are things you saw during that point in the cycle, and how do, owners, operators out there make sure that they sort of make it through here the next couple of years if it is choppy out there?
Sure. Yeah. So exact same experience as you. We were just trading properties hand over fist up until, about, I'd say 2007, 2006 was good. And, real estate's a lagging indicator in the economy. So we were even surfing pretty decently through 2008 with some banks. LaSalle Bank comes to mind, which is no longer around in Chicago because they were one of the most aggressive lenders at that time. But what, I saw the owners that failed and the owners that succeeded, two very different owners. If you look at, someone that's been in the business for a long time, they might have their own, by today's standards, if you look at like an S2, chances are, even if they're over leveraged and, I'm not saying they are, I don't know, the situation, but just using them as an example, they're probably not going to give back much property because they're a great operator. The lenders are aware of that. And back then the situation was like, look, it's the economy. If this is a good operator, the rents are at market, the occupancy's at market, the property's well kept, what's the lender going to do? Take it back and do a better job? They don't want to take back the properties. Like you said, your job was to make sure that, the payments were made. And they generally did workouts with, those folks of, hey, let's switch to interest only for a while and, see how that goes. And it went through the workout process. So you didn't see too many properties that were A or well-kept B-class properties going back to the lender. It tended to be the folks that bought in 06 at peak pricing and over-leveraged, and then just started cutting their expenses in order to make the payments. And, maybe they just weren't as experienced and thought, they could get through it by cutting expenses and lowering their standard of tenant that they would let in. What that does is it just scares away all your good tenants. You're replacing your good tenants with bad tenants. You stop doing the repair and maintenance that you should be doing and all the upkeep, and the property just cycles down. Those were the properties that went back to the lenders, and that was the stuff we were selling 2010 through 12 and 13. Really started selling some properties in 09, but there's a gap of time there where, and I think Paul will echo this, but tell me if I'm wrong, Paul, from 2008 to 2010, there wasn't much going on. Everyone was trying to figure out, what the next move was, and properties started going back to the lenders. And that's when you started seeing, transactions happen again, but there were just very few transactions. It's the calm before the storm, if you will.
So how would somebody know that, a lot of people trying to step back into the market, a couple of general partners, they're beating the drum saying, I'm raising 500 million, we're going to go out and buy properties. And, a lot of them are afraid, or other general partners are out there saying, well, if the property values are dropping this year, why should I go out and buy right now? So any comments around that? That's Mark or Todd, you can take this one. Just like, how do we know when the bottom is, or do you never know the bottom and you just got to figure it out and just be in the market?
I say, just like you would manage your stock portfolio, and it depends on your size. I mean, dollar cost averaging into the market when it's down is not a dumb idea. I think it's a great time to buy right now. There has been a pricing reset. Values are off, depending on the asset class, between, 10, 20%. So, you do have an opportunity to buy into the dip. Once the market does bottom out, you're going to see a lot more people pile in once values start rising again. And then, the buyer competition is going to push pricing up. And so when it bottoms out for a very, very short period of time. And, if you're trying to time the bottom of the market, good luck. I hope you do it, but you got lucky if you did. Coming out of it, you'll probably, end up buying some assets, but I don't think the values, they might be more distressed than they would have been if you would have bought it a couple of years ago. You might be dealing with more drama on the property and just more problems to get that same asset that you could have bought while, the knife was falling, so to speak. But once it starts going up, like I said, the competition will be there.
Let me just throw in, as a man of experience, I was at a property about a year or two ago. We had done the financing on this 1930s property over in Fort Worth, over in the Rivercrest area of a white settlement. Nice property. People have kept that property in great shape. And so I was looking at, they had up on the walls pictures of what the property looked like when it was originally built, and plans what it looked like when it was originally built. But they also had a rent roll when they opened the property up. Any idea what rents were in 1938 on a property over in West Fort Worth?
$25 a month.
That is, you're right there, $27 a month. That same unit right now is going for $1938. That's $1,938. So all I know is I can tell you that in real estate, if you have a long-term horizon instead of a short-term horizon, and short-term being 2 to 3 years, you will make money and values will follow through. So I want to kind of talk a little bit about, being positive in this marketplace, and why people are still positive about buying properties. And that, we've been waiting for this, and Mark and Todd and James will tell you, we've been waiting for a pullback for 5 years. Just a little bit of a pullback. This thing has been a rocket ship going straight up. And so we've seen the stock market pull back 1929, right after they built that apartment building. We've seen the stock market pull back in the 70s and in 1987. But if you stayed invested, you had done very well. So a little bit of a pullback in this market, I think, is to be expected. And so I agree with Todd on this, is that let's look at this as a long-term horizon. So give me about, if you guys, let's go just do a roundtable. Let's kind of just talk about some of the positive things, why people are still buying multifamily. And I always start with the professor. Professor, give me at least one or two answers, please, up on the big board of why people are buying real estate still, multifamily especially.
Yeah, I mean, to me, I think I'll use the often quoted NMHC quote that there's not enough housing. And
I'm gonna
I
write that
think,
down.
yeah, I think that's true at a sort of a macro level. There is no doubt there's a lot of construction coming down the pipeline, but how many new deals are getting penciled right now? Not many. So yeah, there's going to be some deliveries, this year and next year, especially in your major markets. But I think just in general, I can't remember, Todd mentioned the quote of 470,000 people moving to Texas. I mean, all those people need a place to live, and a lot of those people ended up in apartments, and we absorbed a ton of apartments in DFW, Austin, Houston, San Antonio. And I would love for Texas to break off, and then maybe we have some waterfront property up here in the DFW area. And how great would that be? So I'm going to go with that one. You're going in the right direction in comparison on the demand supply. So going back to economics, demand supply of apartments compared to, let's say, office or retail or even hotels, maybe. So,
all right, Mark, give me an answer. What's up on the big board?
Well, I was going to also just add to that. I saw on the Dallas Business Journal, they conducted a study, and I don't know if it was actually a DBJ, but Dallas-Fort Worth needs 19,000 units per year to meet demand projected through 2035. So that's 4.3 million units. That's a ton of units. But if you consider, we've had north of 100,000 people net in migration per year, 19,000 is really, just at 100,000, obviously 19%. So it could be even more than that. One that I was going to add, one point, is the backstop that is Fannie, Freddie, and HUD. And I think we saw that in action through 2020. But no other asset class has that ability in the office, retail, self-storage sector. So when lenders are pulling back, whether it be CMBS, whether it be banks, Fannie, Freddie, as of right now, and HUD, is a backstop. So as long as properties are stabilized.
Fantastic. Todd, going around the table here.
Yeah, I'd say, single family not being as affordable now with the rising interest rate environment. That's going to couple with not only, those folks moving here to Texas, but, if they were going to buy a home, that might be on hold for a little while until rates come back down or something happens to, make the pricing more affordable.
James, come on.
Yeah. So, when I was back in 2015, when I was looking at, all right, where am I going to go and invest some money? I sat at GE, we did office, retail, industrial, self-storage, and multi. And the thing I think, underappreciate a little bit, people think it's a pain in the neck, but the amount of diversity in your income stream across your tenant base. So the tenant concentration of multifamily is spread across 200 units instead of 4 units. And so a lot of these people are figuring out in office, I had Amazon, I had Microsoft, which were great tenants, but they leased the whole building. And so now my building, which was great and had a huge NOI, is now zero or negative because they just announced that, hey guys, we're actually closing all these offices. No, we don't need this many people and we don't need this many offices. So we're closing these down. So I think that is a underappreciated part. And I mean, I could probably go pull some stats, but I'm guessing in 08, 9, 10, the occupancy of a lot of these properties, if they were well maintained and they kept rents at a reasonable level, they probably didn't drop below 90%. So you were still able to maintain the cash flow.
So office was a challenge. It still is a challenge these days, but retail, where's your money going to go? Is it going to go to multifamily, office, retail? Think of all the stores out there that you used to do business with and heard of. Toys R Us, now Bed Bath & Beyond or Party City. All those places are going to go dark at some period of time. And they have leases. Those leases were for 5 years or 10 years. But multifamily resets typically every 12 months. So it's kind of marked to the market about what's going on. So you can take advantage of that. Let me just throw out a couple more that just came my way in my thinking. There's going to be an opportunity right now. It's happening. So I would start to think about assembling some additional capital of buying on the reset of the valuation of the prices itself. So yeah, there's going to be some additional distress in the marketplace. And you should think about, if you haven't invested in multifamily, you should think about assembling at maybe these lower prices that are going to probably be coming down at that period of time. Buying at a higher cap rate. So that falls in right to what we were thinking about. Buying at a higher cap rate. If values come down and NOI stays the same, you're buying at a higher cap rate. Another thing is, and now we're not tax experts, but it was 100% bonus depreciation last year, 2022. Now for 2023, James, what is it going to be?
80% this year. 80% of the depreciation. So so it's pretty good still.
Yeah, still very good. And so you've got to buy for the income stream, the cash flow of the property. So our advice is to use, no problems about looking at appreciation, but don't only look at appreciation only in this marketplace. Let's be a little safer out there by looking at what the cash flow is. And as Michael Becker's rule number 1 is don't buy in the hood. So just be careful about where you're buying multifamily properties at these days. James, any final questions or words to our friends here?
No, I think maybe you guys just wrap up on sort of any final thoughts on the market and, advice for, let's do a section on advice for current owners and then advice for potential buyers out there. So let's go with current owners. What would you tell current owners right now?
I guess I'll kick that off. I hold the course. Like I said, this is a long game. It's a marathon. It's not a sprint. You're going to have to do some sprinting. In the marathon, there will be some hills. You can't have a perfectly flat course, but just know, you're climbing the hill. It's going to be a little tougher than you thought, the course was going to be. But, once you climb that hill, things will get a little bit easier. What goes up must come down. And, that could cut both ways, I guess, on that statement. So I'd hold the course there. And buyers in the market, I guess I'd say, don't listen to all the hype, so to speak, in the news about, the sky is falling and in the, macroeconomic conditions being just absolutely terrible. You really have to look at the market and what you're investing again. And again, we're very blessed to be in the multifamily business in Dallas, in Texas, and more specifically North Texas, and more specifically Dallas-Fort Worth. It's just, it's a great market. It's a hedge on inflation if you're worried about inflation. What I've seen throughout my career, and, a lot of people, worry about the political environment and how that might impact pricing. And, you're seeing it up in the Northeast. But, look, why it's a good hedge on inflation is when, it's let's say a left dominated political environment, that's generally good for Main Street, and you'll see your top line do better. Your rents will go up because, Main Street is a healthier economy. When it the pendulum swings back the other way, there's a cut in taxes there, the bottom line usually ends up benefiting. So, the NOI stays pretty stable, believe it or not, no matter which way the pendulum swings, it's either going to help your bottom line or top line. So I wouldn't be too fearful. Don't listen to the hype, just keep in mind they need to sell ads. So, and nothing sells like fear.
All right, Mark.
I would add, just for current owners, call us at GREA, call Old Capital. No, seriously. I mean, I think about my stock portfolio. I'm not a stock and bond guy, but all that being said, I like calling the wealth management division and picking their brain. Hey, what are your clients doing? What's going on in the market? What should I be doing? So we're in the market. We know what's going on, and we're tracking data and information. So leverage us as a resource. So that would be my advice to owners, because some owners, especially long-term owners, they have differing perspectives, and some are probably pretty sick of all of us cold calling them on a regular basis. But I think we can be a trusted resource. And then for buyers, just generally, I would echo what Todd said, but at the same time, I think I gave that tip. I think right now, if you're an active buyer, you got to be touching base with brokers and seeing what's coming across their desk. I think, there's a handful that do that really well. And not just like, the biggest and best brokers, also, some of the brokers who may be new to market. You never know who's going to come across a deal at the right time. Sometimes it's all about timing. That includes outreach. So that would be my advice to buyers.
Especially having instead of a one person brokerage company. I mean, you guys have 20 some people on the team. So you cast a bigger net out there to run and put into potential buyers for sellers. And then, Mark, can you throw out your podcast? Because I think it's very good and people should be listening to that about what you talk about.
Yeah, so it's Multifamily 5. I started it in 2017, and I probably do, an episode a month or something like that. But the original purpose was to deliver it out on a newsletter. And, it's short and sweet. It's usually, no longer than 20 minutes. So hopefully that people could, as they're catching up on email in the morning or drinking a cup of coffee, they could get a sense of, I interview different vendors such as Old Capital, and just understanding how they're acting as a resource and helping owners refinance properties, boost NOI, or whatever the case may be. So yeah, the Multifamily 5, and you can find that on any podcast app or SoundCloud.
Very popular podcast. James, finish us off, please.
Yeah, no, I appreciate you guys coming on. What's the best way for people to reach out to you guys?
You can reach us at www.grea.com. Me personally at mark.allen, ALLEN @grea.com. And email is probably best, but our phone number is on the website as well.
All right, perfect.
All right. Todd Franks, thank you. Mark Allen, thank you. Professor Eng, thank you. Again, we spoke with the guys over in the Dallas office at GREA. Give them a call if you're looking to either buy multifamily or sell multifamily in the Dallas-Fort Worth, North Texas area, including Arkansas and Oklahoma. So again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.